Welcome back to Market Minutes, everybody. Thank you for joining us. We just wrapped up an exciting Q2, and today I'm joined by Cameron, Director here at Peakhill, focused on our Canadian lending business. Thanks for joining me, Cameron.
Thank you, Hyam. Happy to be here.
Cam, you're on the front line working with borrowers day in, day out. What have you seen over Q2 in terms of transaction volume, interest rates? How is that impacting everything you're doing on the deal side?
What we've seen in Q2 is a larger shift into the MBS market. The MBS market is significantly wider in spreads and has significantly less liquidity as a CMB. You need to have larger volumes for a pool for those actually to be transacted or sold to an investor. So those types of volumes that takes into account wider spreads. What we're talking with our partners and our borrowers is how's the entire portfolio looking, right? So, real estate's a cyclical market. When you look at a 10-year, 5-year, time horizon, rents come up and down throughout the market.
In addition to, a lot of the changes we're seeing in terms of interest rates and transaction volume, one of the other things I've noticed are changes to CMHC guidelines. First being rental holdbacks on new construction, and the other being CMHC premium. How have those two changes had an impact on what you're seeing in the business?
The holdbacks in the MLI space, essentially means that developers that were building at 5% down will now have to put 25% down. When we're looking at construction loans, liquidity might not come into play with an application, but when we're, assessing the risk of an actual loan, liquidity is top priority for Peakhill. When you go from 5% to 25%, that's a lot of your capital that you need. We're seeing AAA clients get hit with a rental holdback on their construction loans. I would say in tertiary, secondary markets, it's much harder rather than, your primary markets. And then as well, your loan sizes. So, larger loans means more absorption to the market. Those rents need to be achieved and they'll ensure that they're there. But with the increased changes in July, the premiums, I would say, we did try to reach out to as many clients as we that needed that type of support. We wanted to reach out to them to understand if they needed to get these applications in. We closed over 120 loans within 1 week. The premium changes, that be it maybe an accounting perspective or an overall risk perspective, but I think it's important to note that it is a cost that comes with these types of loans. They're qualified on a net versus gross, so there's no change to the actual net loan amount. But I would say, it's important to know that if you're going to take a 95% loan, you might be over 100% actual leverage for your value. So I would say being glass half full on a value is, being conservative is important in a market like this. Having experts such as Peakhill and knowing the type of markets we're working in and understanding that actual value and being conservative with that value, I think is important. We don't want to be aggressive here and have a loan that's at 120%. Like, that's ridiculous, right? So, it is important to be confident in the types of numbers we have. And, obviously our partners are confident in our underwriting ability, and being, a number one lender with CMHC, they're comfortable with our recommendations with these types of loans. And, keeping that type of relationship with CMHC and our clients to bring together a COI that makes sense for the client, that premium is just going to be accounted for.
A lot of moving pieces in business, both in terms of what's going on in the marketplace, what's going on with CMHC and the rule changes. What's top of mind going into Q3?
Our focus is to work on the volume. So year over year, we're up in volume of business, but, I find the allocation space within the 5-year money is always a challenge. Peakhill, we find ourselves always trying to find different avenues to fund these types of loans. 18 to 24 months ago, we saw a lot of applications go in within the 10-year term. So I'm expecting to see quite a bit of construction term deals come to fruition within the 10-year market. And, ultimately at the end of the day, I think 5 years is still going to go up in pricing. There is a significant delta between the 10-year and 5-year. And because of that, borrowers just want the cheaper cost, even if that means the spreads are wider. So I still expect to see a larger increase in 5-year. Hopefully we'll see more in 10, but that being said, that's just going to come from construction deals being turned out. And in a market where there's uncertainty within, CMHC making changes or higher levered loans or decreasing rents, it's important to have partners such as Peakhill that know exactly the type of market we're dealing with. What we pride ourselves on is solution oriented, being fast, being the smartest one in the room, and being, cost effective. I think it's important to have, and I think Q3 and Q4 will show that type of volume and the amount of business we do, especially when a market where CMHC might come out with different changes in the future as well. So having someone on your team like that will be the most important part of your business.
Thank you very much, Cam. Appreciate your time today.
Thank you, hon. Appreciate it.